Hello, and welcome to the Certified Equity Professional Exam Overview webinar for Level 2. My name is Pam Chernoff. I'm the Curriculum Coordinator here at the CEP Institute. This segment of the webinar is focusing on corporate and securities law. The webinar is provided to assist you in your exam preparation process, and this Level 2 webinar is being conducted by Christine Zwerling, CEP, who is a Senior Manager Equity Operations at Twilio, and is also a member of our Curriculum Committee on the Law Panel. So on Level 2, 28% of your test is on topics related to the law, corporate and securities law. You'll see a few more than 28 questions because you'll have a 110 question exam, and 10 of those are experimental items that are not scored. They're not identified, but because they exist, I would expect to see a few more than 28 questions. And just as a reminder, you are responsible for the topics that were covered in Level 1, and you should be prepared for questions that may have been things you read about at Level 1, but are more difficult iterations of them for Level 2. And on that note, I will hand this over to you, Christine.
Great, thank you, Pam. So I also want to suggest that if you are taking the Level 2 exam, and especially if it's been a while since you took the Level 1 exam, to go back and listen to the Level 1 webinars too, because we're going to kind of pick up here, assuming that you have that knowledge that we conveyed there. So jumping into just a little bit of a refresh on the Securities Act of 1933. There are two securities rules that are acts, I guess, that we are under in stock admin mostly. So one under the Securities Act of 1933, this covers the shares of stock sold by the company to investors, so that it must be registered with the SEC. The S1 is what a company uses to register their shares for an IPO. S8 is used to register shares for a stock plan. And then this is also prohibits fraud, misstatements, and material omissions in the registration statement, but also includes a number of exemptions from registration. So let's move on to the next slide and talk about one of those registration exemptions, Rule 144. And what you'll remember from Level 1 is that there are two parts of Rule 144, this part is talking about the exemption from registration. So under Rule 144, the company must be current in its reporting. The shares to be resold must have been held for specific periods. We've listed some here, but they're also further detailed in your textbooks. The shares, and this is another piece of it, is that the shares sold within a 3-month period may not exceed the greater of 1% of the company's outstanding stock, and then the average trading volume for the preceding 4 weeks. And then the shares must be sold through a registered broker or market maker, and the 144 file must be filed with the SEC at sale or prior to sale if they're selling 5,000 or more shares or $50,000 worth of stock. And this is if the shares are not registered. So this is to qualify for a registration exemption. And moving on to the next slide, another exemption from registration is under Rule 701. And 701 exempts shares sold by a privately held company through compensatory arrangements. So we're looking at our stock option plans and that type of thing. This is only available to privately held companies. There are limits to the amount of stock that can be sold within a 12-month period. And it's the highest of either $1 million, 15% of the outstanding stock, or 15% of the assets. And there are additional disclosures required if there are sales within a year that exceed $10 million. And moving on a little bit more on 701, there are two different types of employees that you could have covered under Rule 701, affiliates and non-affiliates. So affiliates are your executive officers, non-affiliates are everybody else. So 90 days after an IPO, because remember, again, 701 is only an exemption of registration for a pre-IPO company. So 90 days after the IPO, only the broker requirement from the prior list applies. And then 1 year after purchase, those shares actually just come grandfathered in on our freely tradable. But for an affiliate, the shares still must be sold under Rule 144. And then 90 days after the IPO, the Rule 144 holding period stops applying, but they still have to file the Rule 144 form and that type of thing. And that's how I said when we were talking about the Rule 144 exemption from registration, there are two parts to the Rule 144. There's one, the exemption from registration, and then there's two, sales done by affiliates. So even if the shares are sold by the affiliate under the Rule 144 exemption, they still need to comply, affiliates again, with the Rule 144, the application to executives, which is filing the 144 form, and it's different provisions in there, which we covered on level 1. So you can go back and listen to that webcast again, or read about it in your text because it's spelled out there very clearly. Okay, moving on to this super fun schematic of the various registration requirements. Rule 701, this is pre-IPO, and the shares are restricted. There's special resale provisions apply 90 days after the IPO. And then moving on, Reg D, this is shares are restricted and all requirements of Rule 144 are met. And we're going to talk more about these at level 3, so you don't have to study up and make yourself crazy trying to find the materials on Reg D. Then the company has an IPO. They file their S1, and then they file the S8, and this covers the shares available for grant, and then the lockup end. So I'm not using the time periods on here. So Rule 701 applies to the exercise of options, the issuance of restricted stock before the IPO. Then the company goes public. They do an IPO. They've registered their option plans on a Form S8, and those can be done concurrently or within a few weeks of each other. Then the lockup ends typically after an IPO. The bankers that helped the company go public will put a blackout period on employees and insiders trading stock for a certain period of time once the shares are trading on the market. This is to kind of let the stock price settle down before they're releasing more shares into the market. And this can be anywhere from 3 months to 6 months. Sometimes it'll be 6 months, and then they'll notice the stock price is kind of reached a normal trading level and volume, and they'll open it up a little sooner. It all depends. And then for any grants that are made once the S8's filed and exercised, those are freely tradable. They're fully registered shares. Unless the person is an affiliate, then they have to still comply with the 144 affiliate rules, filing the 144 form and that type of thing. Okay, let's talk a little bit about the S8 on the next slide. The S8, again, this can be used anytime after becoming subject to the reporting requirements. So like I said before, they could file this immediately after doing the S1 and going public, or they could file it a couple weeks later, however they want to do that. It is filed with the SEC for a fixed number of shares, and it's effective immediately. It incorporates other documents by reference. And this will be other like reference to the proxy statement, the 10K, the S1, whatever else has been filed that contains the information that's needed to comply with the S8 rules. It covers offers and sales of securities under an employee equity incentive plan to consultants, advisors, employees, officers, and directors. The shares can be transferred to family members without affecting the registration status. And it permits all plan participants except affiliates to sell the stock freely once the vesting restrictions lapse. And again, we've talked about this a couple times. Affiliates must still sell pursuant to Rule 144. Okay, switching gears to the other Securities Act that we work under a lot in stock admin, the Securities Exchange Act of 1934. Again, we went into more detail on this, on the purpose of it on level 1, but it does regulate the public securities markets. So this is once your shares have been issued, this regulates the disclosure of information and the actual trading of the stock. So it ensures that all investors participate on equal footing and have adequate information. And there are a number of different provisions, but the ones listed here on this slide are the ones that we look at the most when we're administering stock plans. Section 10 prohibits the using deceptive or manipulative practices to sell stock. Section 12 requires registration of stock that will be traded in securities markets. Section 13 requires ongoing reports. That's a 10K, 10Q, annual reports. Section 14 governs proxy solicitation. And Section 16 governs officers and directors. So let's dig into Section 16 a little bit more and how it applies to stock options and stock appreciation rights. So we had talked about this on level 1. Changes to beneficial ownership for an executive needs to be filed with an officer or director, needs to be filed on a Form 4 within 2 days of the transaction occurring for anything that's not exempt. So the grant of an option is considered a purchase. It is exempt from the matching rules of Rule 10B of 16B3. So remember how we talked about something couldn't happen within 6 months of each other? So the grant of an option is considered a purchase for Section 16, but it's exempt if it was approved by the board or approved by a committee of non-employee directors or approved by shareholders or ratified after the fact and held for 6 months. Then it needs to be reported on Form 4. The exercise of an option is exempt from matching if it's in the money, so it's not an underwater option, and then you get that reported on Form 4. And then the expiration of an option is actually exempt from matching for short swing profits recovery and from reporting. Unless they're being paid something for that expiration, then that has to be reported. But if it's just a straight expiration of the option grant, then it does not have to be reported. Moving on again to the application to stock options for cancellation. So this is what I was just talking about. If no value is received, it's exempt from matching and reporting. If value is received for the cancellation, it's exempt from matching if one of the following are met, that payout was approved by the board, a committee of non-employee directors, or approved by shareholders, and then it does have to be reported within 2 days. Repricing is considered a cancellation for value, and the replacement grant needs to satisfy the grant requirements for exemption and is reportable on a Form 4 within 2 days. So, and then moving on to the application of Section 16 to restricted stock. The grant and purchase of stock is considered, the grant or purchase of stock is considered a purchase. It is exempt from the short swing profits matching rules if, again, same thing as before, approved by the board, committee of non-employee directors or shareholders, and held for 6 months, and then it's reportable on a Form 4. And then ESPP, this is always my favorite kind of fun trivia thing, is the purchase is considered a purchase, but it's exempt from the matching rules under Section 16B3 if pursuant to a tax condition plan. So if you have a Section 423 ESPP, the purchases are exempt from the matching rules. The purchase is not reportable if it's exempt also. However, the total shares purchased needs to be reflected on the next Form 4 totals with a footnote, or Form 5 by year end. So this is the funny one. It's like if you're ever at a party with a bunch of securities people, it's a fun trivia thing where if you have a Section 423 ESPP, when officers purchase shares through that ESPP, that purchase does not have to be reported on a Form 4. On the next Form 4, you just need to footnote that the total number of shares owned increased by X number of shares because they were purchased under a tax-qualified ESPP method. But all of the securities people I ever talk to always really want to file a Form 4 for the purchase under an ESPP, which is fine. And shareholders like to know that somebody's purchased shares, so it's fine. But it's a fun little trivia for any nerdy stock admin party you're at. So moving on from that one to the disclosure requirements. Regulation SK, items 402 and 405, You've probably heard people talk about this when they're getting the annual documents ready, the proxy, the 10K. Those they'll ask if there's any 402 or 405 that need to be disclosed, and that is a clear, concise, understandable information on all compensation paid to named executive officers. In the proxy tables, that's the disclosure format is required in proxy solicitation statements and the summary compensation table in CD&A. If you look at the proxy rules, they spell out exactly what the tables are supposed to look like. If you look at a proxy for one company and a proxy for another company, those tables are going to look fairly similar. And again, this is to try to make it so that outside shareholders can compare apples to apples and they understand what they're looking at. The Form 10K and proxy statement, if the compensation plans are submitted for shareholder approval, the stock plan tables must show the shareholder approved plans, non-shareholder approved plans, shares that are issued upon exercise, weighted average exercise price of outstanding options, and the number of shares available for issuance. And this is where you also have to file if there were any late Section 16 filings. So if you were supposed to do a Form 4 for something and you missed it, but you filed it a few days later, you have to disclose here what happened. So this is the main reason that people try not to have late filings, is they don't want to have to subsequently disclose it. But I think most larger companies, if you pull up their proxy statements, most of them have at least one late filing. So you can kind of see what other people have done. If they have a lot of late filings, that can be a clue to investors that maybe the company's hiding something or doesn't have clean procedures either. So moving on to the next slide, for the named executive officers, probably heard around your company of NEOs. When you're in the news, they'll talk about NEOs sometimes. That is any person serving as the CEO or CFO during the last fiscal year, and the next 3 most highly compensated executive officers whose total compensation, not just their salary and bonus, exceeds $100,000. And they were serving at the end of the last completed fiscal year. Could be up to 2 others for whom disclosure would have been required had they not terminated. Then going on the disclosure, these are the different tables. I think we just read through these also. You can look at these here. Again, these are specifically scripted out in the proxy rules. You can look them up in the proxy rules. I think they're also laid out in your text materials. So you can see when you look at the summary compensation table for company XYZ, it'll be laid out in a very similar format to the summary compensation table for company XYZ, ABC, XYZ, whatever. They're gonna be laid out in the same format. They'll be footnoted. The footnotes could go on a page or 2 describing how they fit something into a particular category or giving more information on it, but they will all be laid out in the same format. So if you are pulling this data, this is one of those things where I find when companies are pulling this data, or outside counsel or whoever's putting together the proxy tables, they don't always ask the right questions. So if you are familiar with what these disclosures are, you can help them not accidentally miss looking for some information. I had one outside counsel asked me for all of the stock option information for the officers, so I gave them all of the stock option information, and then I asked them what it was for, and it was for one of these tables. And I said, well, we do RSUs also. Do you need that information? And we have ESPP. Do you need that information? So it's really going beyond that, just what you're asked for, and it's really understanding what's in those tables and making sure that you're providing the best information. Oh, and that's it. Yeah, I was so excited. I could go on for hours about this stuff.
And I will add, for the disclosure tables, there's a good section in the selected issues in equity compensation that really walks through what's in those tables one by one. And I think studying that section would be a good idea. So thank you, Christine. For candidates who are interested in additional courses that might help with your exam preparation, we've listed a couple options on this slide. But I've got to give the disclaimer here that the exam overview webinar is provided to help you with your exam preparation, but in and of itself, it's not sufficient exam preparation. All of the test questions are developed exclusively from the CEP assigned materials, and you should study those textbooks thoroughly. This webinar will be available to you for unlimited viewing until the exam date, and the same is true of the webinars for all four categories of questions that you'll find in the Level 2 exam, and you can also go back and listen to the Level 1 webcasts. And I would completely agree with what Christine said earlier. Those Level 1 webinars can be a good way of refreshing your memory on some of those things that you read about at Level 1, because those are still fair game for testing at Level 2. And on that note, thank you so much, Christine, and good luck on the test, everyone.